Hey everybody. Wanted to take a few minutes to talk about the differences between a down payment and closing costs. A lot of people think that a down payment and closing costs are the same thing, and they're not, okay? So a down payment is essentially the required borrower contribution for a particular mortgage, right? So let's say that you're getting a traditional FHA mortgage loan, okay? And you have an automated approval in the system, nothing special, overall decent credit, nothing that would require that you put more than a 3.5% down payment down on a home. Okay, so for a $200,000 home, that is what 3.5% times 200,000 is $7,000, right? So that's the down payment. Now, what about closing costs? Those are actually in addition to whatever your down payment is, right? So people can get pretty scared pretty quickly when it comes to buying a home because they say, well, we have to put 3.5% down, or 3% or 5%, whatever the number is, depending on the mortgage loan type. Okay, so we have to contribute this amount of money as a down payment. Let's say it's $7,000, and now you're telling me that closing costs are actually extra. Yeah, that's what I'm saying, right? So what are closing costs? Well, closing costs are anything that the mortgage lender would charge, such as an origination fee, a processing fee, an underwriting fee, something like that, right? And they're essentially the same thing, right? It's upfront costs to close your mortgage loan. Pretty much as simple as that. And different people or different companies will perhaps categorize the fees slightly different. Or break those fees apart. Some will just charge an origination fee. Some will break it apart into an underwriting and a processing fee. But at the end of the day, those are upfront costs, right? Well, what else is a closing cost? Well, an appraisal, right? Title insurance for your mortgage, a survey if that's required. Those are all closing costs, right? And even though it's not a transactional cost per se. Generally, if you're going to escrow for taxes and insurance, which typically anything under a 20% down payment, you would more than likely have an escrow account set up and associated with that mortgage loan. So you're also talking about collecting an escrow buffer at the closing table, right? So even though those might not be lender-related fees, and perhaps you're prepaying for your insurance policy or something like that, that's still money that has to come out the door at the closing table. So what do we do? How do we minimize that, right? So that's essentially what this educational video is to talk about a couple of different ways to help offset those closing costs and what at the end of the day ends up being the most beneficial way of structuring a deal for the borrower. Okay, so a lot of home builders and a lot of lenders will offer something called premium pricing, right? Some of the big track builders are just absolutely notorious for doing this, and they'll basically say, hey, we'll give you, let's say we'll give you $3,000 to help offset your closing costs, and then here's your associated interest rate, right? Maybe that rate's a 5% rate. Well, what if there was an alternative way of structuring this to where you could keep your low rate, but continue to have those closing costs offset? So what do we do? Okay, so let's take a look at that right quick. And I'm going to go ahead and kind of minimize this screen a little bit so we can take a look at these figures. Okay, so I'm going to move this down into the corner and let's take a look. Okay, so the first example, the kind of the builder example that I was discussing at first, is this rate premium adjustment, right? Where basically we're covering the transactional closing costs, not the down payment, but the transactional closing costs with a rate adjustment and an associated credit that is a credit to your closing costs at the closing table. Okay. Scenario 2 is something called seller concessions in the contract. Okay, so let's go through both. All right, let's take an average purchase, a $250,000 home purchase with a 3.5% down payment. So this is going to be our loan amount, okay? And that loan amount is, you might notice, is slightly higher than 96.5% of the purchase price, and that's because there is a financed mortgage insurance premium in that total loan amount. Okay, so I ran pricing on both of these, assuming a 680 credit score, and this is also assuming that this property will appraise at roughly $255,000. Okay, so we get, with a 680 credit score based on this purchase price, single family residence, we get a rate of 4.25 on a 30-year term. Okay, now I've just thrown in some estimates for taxes and insurance to kind of show you what a realistic mortgage payment would look like, assuming that you're escrowing for taxes and insurance. Okay, so this is a 2.5% tax rate based on a $250,000 purchase price, and that's what you're left with on an annual basis. Now, that doesn't factor in homestead exemptions. That doesn't factor in, perhaps living in a slightly lower taxation area, depending on the school district, county taxes, and so on and so forth, right? We have our mortgage insurance built in, and so that basically gives us a slightly higher than $2,000 monthly payment. Okay, now what we also get here is we basically get our underwriting fee that's completely washed out. Okay, so that's built into the rate, and then we get an extra $3,400 as a premium to help offset our closing costs. Okay, so then what happens, right? We have no underwriting fee. We've got basically a $3,400 credit. All of these basic closing costs, some prepaid insurance, an escrow provision for taxes and insurance, no seller concessions, and we're left with, between our down payment, right, our 3.5% down payment, and our additional out the door closing costs, we're looking at $8,750 out the door. Okay, now let's look at option 2 with seller concessions. All right, so let's say that instead of doing it that way, we go, you know what? We don't want to have a rate premium. We want the lowest possible interest rate and lowest possible mortgage payment that we can make work in this particular scenario. So what if, so you agree, okay, you agree that the home is worth $250,000. The seller agrees that the home is worth $250,000. So maybe what you do instead is you say, all right, Mr. and Mrs. Seller, we'll pay you $255,000 for this home, okay? But in return, we want $5,000 in seller concessions to help offset our closing costs. Well, does the seller care? Well, as long as the property will appraise for $255,000, okay, then really the seller doesn't care. They're getting the same amount of net proceeds at the end of the day, right, when they sell their house. And so what you get, though, is you get $5,000 of seller concessions to where you effectively finance in your closing costs portion of the transaction. Okay, so what happens? Well, what happens is that we have a slightly higher loan amount. So our loan amount's about $5,000 higher, okay? But we get a much, much lower interest rate, okay? So this was today's pricing. So that's November the 26th, and your pricing could change, and this is not a loan estimate, and yada, yada, yada. Here's all the disclaimers, okay? But this was accurate pricing as of today, all right, for this particular scenario. So same amount of property taxes, same amount of insurance, same mortgage insurance factor, okay, based on a slightly higher loan amount, okay? And we have a payment that is over $130 a month cheaper because our interest rate is lower, okay? So even though our loan amount is slightly higher, because of the dramatically lower interest rate, our mortgage payment is significantly cheaper. And that even comes with a rate premium to kind of help offset our underwriting fee. So this rate, this 3.125% rate, is actually that's basically with a $530 lender related cost. Okay, so let's go down the list. All right, we've got $9.99 underwriting fee. We've got $470 to help offset that. We've got our appraisal fee, our title policy. Usually the title policy is paid by the seller anyway, but throwing it in there for good measure. Got some extra recording fees. We've got a survey. This is kind of standard survey fee, and usually that's something that the seller has on hand at closing. And usually we don't have to charge for a second survey, but it's there just in case. Okay, we've got some prepaid insurance. We've got our tax and insurance escrows, the same exact numbers as the previous scenario. Okay, but what happens? Well, now we have $5,000 in seller concessions to help offset our closing costs, right? So at the end of the day, we've got what? We've got $1,100 out the door closing costs, right? Instead of this $2,140. So then we've got a slightly higher down payment, right? Because 3.5% of, if we go back up here, 3.5% of this purchase price is slightly more than 3.5% of this purchase price. Okay, so our down payment is slightly higher. Our net closing cost, it's the same close to the same number, but it's just calculated slightly differently. Okay, and so we basically have a total out the door of 10 grand as opposed to 10,900. Okay, so not only are we saving money on our kind of total out the door closing cost, that where you're bringing a cashier's check to the closing table, right? So not only have you saved, my gosh, almost $900, so $880 roughly, right? Not only have you saved that much money at the closing table, but your payment is about $130 a month cheaper. So let's do that calculation right quick. So we're saving $131.52 a month in a mortgage payment, and we've saved ourselves $879.76 at the closing table, right? So what I am getting at here is don't fall into the trap of a rate premium adjustment. There is more than likely a better way to structure that deal. Now, the caveat to this is that if the property appraises low and we can't build those seller concessions into the deal, then sometimes a rate premium is really the only way to get us to where we need to go. And taking taking this $2,000 a month payment and instead of $1,887 a month, well, sometimes that's the only way to build equity in a home instead of renting. And I'm fully aware of that. And I'm fully aware that scenario one sometimes is the only way to get the deal done. But more often than not, I would say 9 times out of 10, scenario two ends up being a viable option, right? Seller concessions are a normal thing. Appraisers are used to seeing that in the contract. Most contracts are structured that way whenever you're trying to minimize funds out of pocket. Seller knows about it, realtors know about it, and at the end of the day, this is oftentimes a better way to go. So hopefully that helps. If you have any questions about this, please don't hesitate to reach out. And of course, my contact info should be listed below. It's on my mortgage page, should be at the bottom of this YouTube video, but you're also welcome to shoot me a text or give me a call on my cell phone. That's area code 361-232-9117. Or feel free to reach out on my Facebook page. You can search for Trey Camp Mortgage Loan Originator, or you can search for the @Consult with Camp. That's the actual kind of page tag or whatever you want to call it on Facebook. And so feel free to shoot me a direct message if you have any questions about this and how these numbers pertain to your specific purchase scenario. All right, guys, thanks so much for listening. We'll see you next week.